Thank you, Newton. To set the context, so briefly about me, I joined 500 startups 7 years ago to invest in Spanish-speaking and Latin American deals, and then have done a good variety of companies. Now it's about 60 deals that I've sourced for the organization, including some that are at scale, including Talkdesk, Viva Real, and then some of them with exit, for instance, Cine Papaya and Ad Espresso. So it's been pretty exciting to open sort of 500 that it's based in Silicon Valley for global founders. And then I founded an organization called Brazil Innovators. I'm Brazilian, where we built out a network of startups, and that gave a lot of input, particularly on what we're gonna cover a little bit later. It's the deal flow component that gave me access to a lot of really great talent. And as a venture capitalist, as an investor, that's one of the key components of investing. And then also part of the Kaufman Fellowship program that sort of opens and connects a global network of investors. So we're gonna cover today mostly around investment theses, and the investment, this topic on this 2 weeks program with Stanford, that's one of the key thing we're gonna work on. The fundamentals of that, it's really who you are, what are you going to invest, why are you relevant, and how you're going to be successful. And ultimately, it's generating return either to your investors, we put here as a limited partners, or even yourself if you're looking from an angel investor perspective. So it's that like very clear declaration of who, what, why, and how you can deploy the capital. And most of the time, very often, it's your first time fund or you're investing for the first time. It's unproven, but you really aim to sort of make it work. So a lot of it, it's being able to communicate and put it sort of very clearly what your thesis is as you start doing that investment. And then there are a few things that it's important to use as a guideline. First, to be classified as a good thesis, once you have that very good thesis, it's very easy for the people in the network to send you companies and startups, right? So if you tell me exactly the type of companies and your thesis that you're looking for, that becomes like a channel and sort of easy way for people to send you. So a good way to test whether you have a good investment thesis is when founders and investors, when they send companies to you, that's quite filtered. Another very good indicator when you present a thesis is when your investors, the limited partners, will want to invest in you. That's also like a clear sign that you have a differentiation on your thesis. Another component is it really helps guide through what type of companies you want to invest, right? So as we dive deeper into the opportunity assessment, which companies you want to look for, the overall sort of arching composition is the thesis, and then you can then see which companies you want to involve. And a good reminder is that actually it evolves over time because the market opportunity and the trends also change. So it's very important when you're defining your thesis to have that general framework, but also be very open on that evolution of the thesis. So I'll give you a few examples, and this is more on like the elevator page, sort of one-liner of what a clear thesis look like, right? So the first two, it's from a Union Square Venture. It's a New York early stage fund. And the first two parts that you see here in the slides is you see that there's an evolution actually in their thesis. In 2011, they said, we want to invest in large network of engaged users, differentiated user experience, and defensible through network effect. So at that time, they were looking at a lot of marketplaces. A lot of new marketplaces were built in 2000, 2011, and they ended up investing in a lot of really good companies around that. But the market sort of evolved, so a lot of the marketplaces and some of the opportunities were taken. In 2015, they wrote, as market mature, we look for less obvious network effects, infrastructure for the new economy, and enablers of open decentralized data. So they look at blockchain, as a very good opportunity, and that's why they also invest in a lot of companies in that space, right? So that ability from a market perspective, that you say these are the companies I'm looking for, so every time I look at a company within that sort of thesis that falls into that interest that they have, it's very easy for me as a potential co-investor to send them the deals. Another good example is the SaaSter Fund by Jason Lemkin. They are very specialized in software as service, the SaaS companies. So in his one-liner, an elevator page, he says, we look to invest in SaaS companies typically once you have, or the founder have at least 10 affiliated customers, and invest somewhere between $500,000 to $6 million. And the who, right, like we're saying, is like Jason Lemkin has built companies, so they use founders helping founders, and then they help a lot on recruiting, right? So with that end, it's very easy for me to know, oh, what type of companies they will be interested in, so I can send software service companies to them once they reach a certain traction. In this case, they want to see at least sort of 10 customer that is not your mom or your sort of close network. And in the last case, as an example, this is 500 Startups investment thesis, and I'm gonna walk through the who, what, why, and how with 500 diving deeper. But in a one-liner, we believe in a large diversified portfolio of early stage investments because we believe that it reduces risk and maximize potential return compared to traditional venture VC. So this just gives a bit of overview of, even after you've gone really deep into your investment thesis, it's very important that you can articulate when you see someone in a networking event, when you're speaking in a conference, to articulate very clearly what your investment thesis look like. So diving deep in each of those components, right? Who are the GPs, or who are the general partners who are going to build a fund, or you as an individual angel investor? Also, it's very important that you define who's going to be investing. Then there's another important component is what. So defining the sectors, whether it's the geography, whether the stage, and then this comes in the opportunity assessment deal criteria. The why is why your thesis is right, because the timing, it's very unique. We've seen in the past few years, for instance, the rise of micro VCs. That's a lot of the space that 500 Startup is positioned. And so that also, like, it's very important that you are able to show what's your unfair advantage, and then that allow you to position yourself to execute. And then ultimately is how you're going to do it, especially if you're in the process of bringing additional investors, LPs outside. So these are the sort of main ingredients of when you are defining your investment thesis. So when we dive deeper around 500 Startups, we have this sort of very sort of mix between operators. So for instance, Kylie built 2 companies and sold both companies. Then we have this very deep insight into Silicon Valley. So both Christine and Aman work with sort of key companies here, including Google, eBay, Sonos. So there's a lot of sort of deep network into the tech companies. And then I have a lot of experience on building network, because very often that's very helpful, especially at the global level, to connect to key people and sort of build out the ecosystem, right? So when you define the who, it's very important that you think of the composition of the team so that it can be very complementary within the implementation of your thesis. In addition to the sort of key team members in the management team, we actually launch a family of funds. So we have regional funds and vertical funds. For instance, a vertical fund would be a fintech fund, and then a regional fund would be, for instance, our Mexico fund here. We all have like creative names, including 500 Luchadores or Durians in Southeast Asia. With that, that allow us to build this global network of people that are on the ground for early stage investing that can send us very, very good deal and deal flow. So this is a little bit of who is going to be sort of active in the investment thesis, and I would start thinking sort of writing down in your case, like what's your differentiation, who are you, what's your track record, how do you find the deals, and then look at like what is the composition of the team you want to have. The second component ingredient is what are you investing, right? I put here a horse, pretend to be a unicorn, or we imagine them to be a unicorn. I think it's a little bit of hunt for the unicorns, especially the super big winners. What's going to be important on the what is for you eventually to know what does a target investment look like for you, right? So maybe you don't have to deal flow ready, but it's important for you to look at companies and then say, would I invest in this company or not? What are the questions you would ask to clearly determine a yes, no decision? And with the practice of that, and also during the program, we're going to spend time doing a lot of live case studies, is to really start honing into what type of deals you want or don't want to start investing and practicing. So for instance, at 500 Startups, we have done 2,000 investments, and that really helped us hone in of type of companies, and especially among like traction. It's like once we see it, we know on at least in the baseline, how does that compare one market to the other, right? So for instance, if I invested in a software service like accounting for small medium business in Brazil, I can take that same metric sort of line and then take it to Turkey and see the growth rates, see the type of metric that I should be looking at. So very important for you when you think about what you're investing is to really sort of set that framework to say what type of deals it's a yes or no for you. So that's around the sort of second ingredient, which is what. So in our case at 500 Startups, we don't pick particular sector or region. What we select is early stage. We want to come in, our sweet spots, it's early stage investing. We invest average check size $150,000, and we like to write follow-on capital to the companies. And it is across several business model, several different geography, and then several different sort of technology too. So even when you see classification of sectors, sometimes it can be a vertical, sometimes it can be a business model, sometimes it can be sort of related to region, and all those sort of composition, what we believe is the large portfolio approach, like investing in at least 50 and ideally in 100 companies with the brand that we have. Hopefully it will allow us to always find the key unicorns and key companies that can produce significant results to the fund. So this shows sort of briefly, then we have many companies that reach the $1 billion valuation. We call them, well, it's a coin here already, it's called unicorns. But then we said we really like the family of horses. So we added the centaurs, which are companies over 100 million. We have several of them now in the portfolio. And then we always joke that we also have the ponies that are companies that are starting to like look great, and then potentially for those that doesn't survive, majority of the company, we also joke that those are zebras. So you have all the way, ideally we can find the unicorns, but also we want to find the centaurs. And that's really important for us, companies that are over 100 million, because our entry point valuation normally is fairly low or lower to the market because we're the first check to come in, right? So one thing that is really important to measure as an investor, of course, we all want to find companies with a large value and market cap, but then it's how much sort of increase of value after you have invested. It's really what we're measuring. So for us, a unicorn, more than being $1 billion, for us, it's a company that can return more than 50x after we have invested in. So that's sort of a very important classification internally for how we define the winners. So diving on the third ingredient, which is really why, right? Like, why are you positioned to do this? For us, we believe that the seed investment open up, especially back in the days in when the fund started, we really believe that the seed investment has opened a new sort of opportunity for two main sort of trend reason, right? One is it's so much cheaper for you to start a company. So with $50,000 or even less, depending where you are, the founders can really get a business started, a startup in a garage. And then the second trend that is really important is that it's very cheap to distribute that online product, right? You have platform companies such as Facebook, Google, you have the Apple Store to really like distribute in a relatively low cost component. So all of a sudden for us, it's because all these opportunities are popping up around the world, we wanted to be this active global fund with the Silicon Valley basis and build out this network of talent of investors to be investing in deals around the world. So in our case, we built this Silicon Valley global brand in the sort of seed space and build differentiation on that. The why ultimately is why people are investing in you, why a founder is going to take a check from you, especially in competitive deals. So I would spend time on really developing your sort of assumption on why you are differentiated to build your own fund or be an investor. And then the how, right? The fourth component of the ingredient is how are you going to return the capital, right? So let's say if you put in $1 million into work, how are you going to return 3x, right? How are you going to like return that $3 million to yourself or to your fund, to your LPs? So a few key important components here in the how is it's important for you to think like, what is the entry point valuation? How many follow-ons you think you're going to write? How many checks you're going to write? And then how long does it take for liquidity? And in the exit of the return, like how much is that return that you think it will sort of happen, right? So here it just sort of lay out, for instance, when you see here at the bottom part, the 1 to 50, I mentioned like 500, at 500 startups, we like to invest in a large portfolio. So we invest in 50 companies. So we write the first check of, let's say, of about, if it, in this case, as an example, right, like $50,000 checks, right? So we're gonna write that, and then 1 out of 3 of those potentially can get a follow-on. And for the follow-on, we'll write a larger check of $250,000. When you add that up, that will probably be your fund size, because you have to have an assumption to say how many checks I'm gonna write as a first check, how much are you gonna deploy, and then how many follow-ons you're gonna write and for how long, right? Especially if you look at like the stage financing that has the seed and series A, B, C, and D. So you know how much capital allocation you should have for sort of this investment thesis that you have. So this is a theoretical of model assumption. What is really important in the theoretical assumption, it's when you're investing, it's very important for you to say, what do you think, that's why I was mentioning on the exit on that, what do you think is the percentage of the company that's gonna be wildly successful, and how do you define wildly successful, right? In our case, this is a 500 definition, is we believe that 2% of the companies are gonna return 50x, that's our unicorn. Then we have another 5% of the company is going to be 20x, right? So when you look at that calculation of the portfolio that we have, a good portion of the return of the fund is going to come from that 7% of the company. We believe the majority of the companies, especially when you look at 0x or 1x, you're not investing to return 1x, right? Like it doesn't make sense at all for your return, but we really believe like probably like 85% of the companies will not provide any return. And the how and like projecting on those return, it's really important because it guides you really on what's your appetite for risk, right? So in our case, we write a small check. So deploying $150,000, we know that 85% of the companies might not go anywhere. That give us a lot of space for mistake, but also that allow us to invest in very innovative companies, because when they work, they work really well. So the modeling behind it of that percentage, that what's gonna yield the exit, it's really important. So this is just to sort of show on like how we operate here at 500. So this is a theoretical model. Like, let's say if we raise $150 million, so you see here on the left side, and then we invest in really large portfolio, which is around 680 companies. And then you see a little bit of thesis around what's the check size for the first check and how much we believe we're gonna write in follow on. And you really will sort of hone in after you start seeing the deals, right? But you have to start somewhere on the sort of thesis component of saying like, how many companies are going to be successful and what the return you are looking for. So the next slide is going to show now currently 500 already have enough sort of funds that we build out. So we give us a little bit more data. So we sort of back build those data, right? So this is the data from our first two funds. So in aggregate, the first two funds together, the first fund was 30 million, the second fund was 45 million. So that means that 75 million invested in about 577 companies. So you see this number in the sort of first sort of blue block is 577 companies. We normally invest in the super early stage, right? So you will see that progression. Only about 30% of the company moved to Series A. Of that, only half of that Series A moved to Series B, and only like less than half sort of moved to Series C and beyond, right? So for us, a success for a $500 million, that's enough for us to return the fund model that I showed before, right? Although we all want to measure for the unicorns, which is $1 billion company, but more important, it's what is that progression and what's your risk appetite, and also what is the projected return, right? And you have to find that balance out. So very often I hear a lot of investors say, oh, I want to do early stage investor, I want to do an early stage deal, but then they're not very in their math, they think the failure rate it's like really low. So like when you look at the fundamentals of that, it just like doesn't make sense, a bit contradictory, because in early stage you don't know what's gonna work, right? They're really easy to list like 50 reasons why company fail. So it's very important for you to really look at sort of return and the risk that you have with it. So this is on how. So we covered those four things, right? So if everything, like after this webinar, I want you to remember is like the four ingredients on building the investment thesis: who, what, why, and how. And ultimately, what you want to make sure is that that gives you a very good framework into the investing in the deal itself. But that's only like when you're doing investment, that's only like a very small part of the whole equation that you're doing. We all, as investors, a lot of us come into the sort of this space because we want to be investing in the startup. But when you look at this slide, it really shows that there's so many other important activities for you to consider other than the act of like writing the check. So when you're writing the check, we're going to cover a lot in the program too, is the legal terms, the dynamic of those, the negotiation component. So there is the deal itself, but before you write that check, there are a lot of components which is really important around how you're going to find that company, right? We call them really like what's going to generate the deal flow component. And even once you invest in the company, actually that's where the work starts. Like very often we see people like celebrating, especially founders celebrating on raising a round, but majority of the work is going to be done really after. So in this, we list out a few activities. For instance, for deal flow, you have serious things you can do. And then in the value add, and that goes back again to when you design who is, if you are sole investor, if you're sole GP, would you be able to do that is listed here on the right, or are you like promising that you're going to do any of those, right? So for instance, would you help them connect to potential clients? Would you work with them on the M&A? Would you help them grow? Would you be able to help them recruit? There are a lot of activities that after the investment that it's there. And then what you want to also ensure is that, let's say in our case, we have invested in thousands of companies, what type of infrastructure and team infrastructure I need to build to support or maybe not support companies, and make it very clear in that end, right? So I would encourage you to start like sort of writing down, like, would you or can you really do value add? I hear a lot of us that I can do value add, but very often they get more in the way of founders than really being able to create sort of a value add, especially in the perception of the founder on that end. So that will allow you on your thesis to say, would I take a board seat? Would I be active? And then how do I build the composition of my team to ensure if we do 1, 2, 5, 10 of those things of the value add component. So this is just a reminder to say the investing itself is a small part of like the big, much bigger equation of and this, when you start mapping out both the deal flow and the value add, it allows you to hone in sort of the 4 ingredients of the investment thesis. Diving much deeper into deal flow, it's one of the sort of most important component of the fund, right? Or as a good investor, if you see, let's say if you tell me that you want to invest in 10 companies and that's your portfolio size, and you want to invest $1 million in those sort of 10 companies. If you see 30 companies, your selection of the best 10, you would have like a criteria based on those sort of 30 companies. If you see 1,000 companies and you're only going to select 10, actually your filter and your option is way higher, right? So the top of the funnel of the type of companies you see, like I think the number is very important and the quality is very important, right? So that's why the more active you are around what type of deals you want, also you qualify the deals that comes in. So it's finding that balance between quantity and the quality of the companies that comes in. And I think there are a lot of components to really build out the deal flow. The reason I got the role to be an investor, it's because I developed, before working for any of the funds, I developed a really proprietary deal flow to a network that a lot of people didn't have before, right? So I spent a lot of time with founders, especially in at that time in a specific geography that was Brazil, and that gave me insight to like sort of the best talent. And at that time I didn't have the capital, I was just connecting to a lot of funds and got offered for a few funds to work for them because I was sort of providing the deal flow. So as you are sort of starting to invest yourself or interested in stepping into the venture world, what we very often try to see is, do you have access to that network or to a network that the fund is interested in and maybe we don't have access to, right? So very important is to like develop your own deal flow, because that's what's going to be a lot of your differentiation. But ultimately is the question is really like, where are you going to find those awesome founders, right? Like very often you might say, oh, I would, in my, what type of companies I want to invest, I only want to invest in companies that have serial entrepreneurs. Okay, that's fine. That's great, but how are you going to find them, right? Like, are they in your market? Would you go to certain like market or certain network to do it? So I think the ultimate question is that sort of hunting that you're going to go through to find the founder, especially if you're starting off, people don't know about you. So it's very important to start building the brand, right? So that story of your investment thesis, it really sort of help you hone in the market. So whether for a lot of introverts, they like writing or speaking or like attending events, like just ensure that the market knows what type of deals you're looking for. Networking definitely helps. Sometimes you can use the online sort of referral or LinkedIn or email outreach. I've seen some funds that they call like founders every 3 to 6 months to see how things are going, so they continue to build the relationship. So the networking, it's very important. Often people invest within their network, right? Like whether it's an alumni network or a university network or people who has worked in a certain company. We've seen, for instance, like in the Bay Area, a lot of things sort of started. There's sort of this family of like the PayPal mafia, or in a lot of the market, especially you start having like companies to exit, would they sort of be able to build out a very good talent pool that you can invest, right? And then there are currently a lot of platforms, for instance, like AngelList, Product Hunt was sold to AngelList, or sort of local crowdfunding platforms that you can find also like really great startups. And accelerators often also a good sort of a source of potential, especially if you're not doing that early. So whether it's 500 startups, Techstars, Y Combinator, it can also be a good source, especially those sort of demo days of deals that you have. And very often you can find in other activities, right? Like sports or however you do it, it's important that you have the deal flow component. And then this is sort of the part that we're gonna spend a lot of time during the Stanford program. It's really that two component, right? You have to hone in your investment thesis, and then you have to look at what deals and when do you say yes and no, right? So here it's a quick sort of list out, what is sector, what is team, is it the market that you want to invest, is it the business like business model or the unit economic? So what is it within your framework that and deals that you want to invest? And then I'll even like define like when is a deal breaker, right? Like very often I love to like have investors to very quickly tell me like, yeah, this is not a deal that falls into my sort of sweet spot because it's too late stage or however it is. Then it also give you ability to say no very quickly, which really helps you sort of build reputation. It's very important that you build a reputation as an investor in this market. So these are just sort of some of like the sort of list questions, but then we have like more like sort of specific framework that you can apply. And then a lot of the pattern recognition that sort of it says here, it's really by looking at enough companies, it gives you a reference point for it. And then this is the last slide before we open for question and answer. Very often we look up to like funds that are extremely well established, whether it's Sequoia or Andreessen. I think there are a lot of funds that people like get really excited about. But if we are coming in as an investor for the first time, you have to really like start somewhere, right? Just like 500 when we started the operation, it wasn't like it is today. And I feel like we're constantly sort of building this brand and constantly hustling. So this is a case study. Both Pocket and Elizabeth attended our first VC Unlock program. They were actually recipient of the scholarship that Newton was saying. And they actually found a sort of this angle to build sort of find deals that are sort of millennial based or female customer base, and they get it really as a customer, right? And before sort of they come together to build this sort of vision of almost like why they're differentiated or who they are, it was just the vision when they came to the program. They didn't come together, actually they met during the program, and now they've done over 30 deals through this fund called SoGal. So it's just really exciting. Like as you start writing of like who you are or what the team members you want to find, and then what do you want to invest, and then why you are unique, I think those things can really sort of come together and set you aside, especially if you have differentiation and deal flow that no one else can deliver. And I think this is the really amazing thing about the sector that we sit in. I think we are also disrupting the venture itself, because now with the ability for you to do so much with $5-10 million, you can, like any of us can sort of really break the ground from the traditional VC, and that makes, I think, the space extremely exciting. So, and that's a lot of the reason when we decided to build out this program called VC Unlock, it's really unlocking all the learnings after we have done thousands of deals here at 500 in the global context. Newton, I'm gonna send back to you to help sort of moderate some questions, and we'll sort of go back and forth on that, but I'll invite you back on the conversation.
Perfect.
Thank you.
I am here. No, thank you so much, Bedy, for spending some time walking through that. The question and answer is going off. Many of you have been writing to us there, and I've been doing my best to try to answer your questions, and I'll continue to do that sort of in conjunction with Bedy. There's a lot of good questions in here, so excuse me if I don't get to yours. But I'm going to start with a question that came from Shiva, which I think is really relevant to the conversation that Bedy has been talking about investment thesis. And his question is, how do LPs, specifically family offices, evaluate the theses of emerging fund managers, uniqueness of their theses, faster path of liquidity, bigger in terms? Essentially, what in your experience, Bedy, have you seen sort of family offices looking at when they're looking to invest in emerging fund managers?
Yeah. So it's a good question. We'll do a little bit sort of fundraising and LP perspective. I think, so since we launched more than 15 funds at 500, and many of the fund managers that you saw in one of our slides, the Global Network, are the first time fund manager. So I can attest to you for sure, raising the first one, it's really hard because it's an unproven thesis. I think specifically with the family office, there are a few components to consider, right? Like one is for the family office, very important often for them, it's sort of preservation of wealth. So it's very important for you to understand that and then say, ask them, for instance, like what is the capital allocation that you feel sort of comfortable on the alternative component? Very often I hear it's 5 to 10%. So when I'm raising capital with the family office, at least I have in mind of like, okay, within their, how much total under management they're doing, broadly, how much potential capital I can raise with them. So I think the first thing is sort of understanding the profile of the investor and then understanding what is the potential check size that they can write. In our case, and especially if you're interested, because I think it depends on your fund thesis itself, as an early stage large portfolio thesis, a good way to pitch them, because it's finding that sort of unique angle, right? So a good way potentially to pitch family office is that I know you're very interested in investing in early stage, but then if you are going to do only 1 or 2 deals, it's going to be extremely risky. And if they come to you, it might be an adverse selection, right? Because like, why would someone want to take your capital just for the cash itself? And if you only invest in 1 or 2 companies, it's just too risky to put like saying that they're all going to become successful. So why don't you use us as a fund or as a GP to see a much larger portfolio, and then you can learn. And if you want to double down in some of the deals, we actually clear up like the noise for you, right? So that would be like an angle, but also I'm like being very specific on that space on the thesis that you might have a large or larger portfolio in seed investing. So I think it ultimately, it depends on the pitch on how you talk to them, but it's finding that angle that there's no way they can do it, and your team and your vision can execute the portfolio, and you're dedicated to do it. And I think the full-time dedication to it allows the ability for them to say, fine, I would love to get exposure into this space. I won't do it myself. So you convince them that you're the best team to execute that.
Perfect. We have a more tactical question for Raphael. But you said that 500's thesis is about diversifying across a wide and a large portfolio. And Raphael is saying, for deal flow and value add in a fund where you plan to invest in 50 companies, how many people do you recommend in the investment team to handle this? And what is the typical team size that you've seen?
Yeah, interesting. So we actually believe, for instance, all the senior partners, one person can execute more than 50 deals because the timing for decision for a $50 or $150,000, it's sort of possible, right? Like I've seen some of the angel investors sort of join some of our programs, like individually they can do 200 to 300 deals. What I think the more permanent question is, after you invest, what's the expectation, like in your side, to be involved in those deals, right? Like in the case of 500 startups, we're very active during acceleration program. So if the company decides to come to our Silicon Valley program and acceleration program for 4 months, we're extremely hands-on. We allocate normally 2 people, like a investment partner, a growth partner, to help them do growth and user acquisition. So it's that like very day-to-day, every week check-in within that period of time. We particularly, for us, it's particularly important after the program that they can raise downstream capital, because it means that someone else can also help them, right? It's not just all on 500 shoulder. After they leave the program, we're really hands off. What we require the companies often is information, right? Because we want to know which companies are working and we can double down on them. We haven't built an infrastructure for companies after they leave the program, but also that's how our fund was sort of structured. So I think ultimately is, as an individual, you can deploy 50, like a large portfolio. I would say a lot of, like some of the literature said, like at least 30 companies if you are interested in early stage, so that you have you can find like at least 1 or 2 companies that are wildly successful, but you have to like set expectation of whether you will be active in helping them somehow or not. In our case, just to sort of close cycle, is we have around 100 people who works at 500 startups, and then that ranges between investment team, legal, finance, and all the sort of different growth team, all the different components within the organization. So we build out a fairly sort of strong infrastructure overall.
Okay. So I have some questions that were asked very earlier on in the conversation. Lauren has asked the question, what's more important for LPs, the right sector at the right time, or domain knowledge and network in a particular sector?
What are the 2 options?
So the right sector at the right time, sort of investing in a particular sector, or having domain knowledge, being, you know, marketing, be it sales, enterprise, and a network in a particular sector.
Yeah, that's an excellent question. I think the LPs, like it has a really wide range, right? Depends whether they're institutional, corporate, individuals. I think they all might have different goals. The big component of that, it's more like going to sort of answering the question on the why. It's what do you think is going to define more why, right? It is a mix between your domain expertise or the domain expertise within the GPs and that unique angle into the market timing. But the market timing can also change, and you are going most of the time be in a fund that, if you're late stage, I would assume 5 years. If you're early stage, it's at least 10 years, right? So when you go a laser focus, sort of narrow, sometimes into some opportunities that might be trendy today, it might be a problem sort of down the line, right? So it's really like navigating how you like hone into that. So for instance, if a few years ago, and we saw that with like partners saying like, oh, VR is going to be big, but it seems to be like all up and coming, like at that time, maybe it will be easy for you to bring the LPs, but then if you have to like adjust the angle, it's going to be a lot harder. So leaning in more is towards the expertise of the investors, of the GPs, the general partners. I think often that like whether that differentiation is because they have certain industry expertise, that is often sort of tend to stay, and that it's less on the vision itself, it's more on the sort of executing team. But it's really a combination of both, and your capacity to really articulate why you're unique and why now is the right timing for them to deploy that capital.
Okay, we'll take one more question. This webinar, we're already a little bit over. We normally run these webinars for 45 minutes, but there's been a lot of action and activity here in the question and answer section. So we'll give one more person opportunity. The question comes from someone who didn't give us their name, but they said, how do you determine the global markets or the geographies to explore, and what outside factors affect your decision?
So that's, so if the question is more sort of applies specifically to 500 startups.
To 500 startups, yeah.
Oh, okay. So it's really interesting. When we started exploring international market back in 2011, probably we were one of the very few funds that was doing early stage at a global level. Most people, especially when we were raising money, most people would just think it's crazy with the early stage across sort of different region, right? So we look at sort of this mix between, can 500, when we go into the market, be positioned to the most differentiated early stage fund or not? So that's like ultimate the question, right? So for instance, we very quickly launched the fund in Southeast Asia because we knew that we can really like dominate that space for early stage. We didn't go that fast in launching a fund in UK because there were a lot of activities, or some activities already happened. So one thing that we'll look at is that gap in the market for the stage or the thesis that we have. So that's one first sort of criteria we have. And then the second, and very often that's what really has driven us to go to an international market or not, is actually meeting the right person on the ground. And then they are the drivers of making the fund happen, right? Even for us, 500 is a fund that has been like very open around like failing. So even like some of the funds we try to launch, we support the founders, founders of the fund, and it might like launch or it might not launch, and then sort of we come back up and then do it the second time. So for instance, like Turkey, we first like found a team member that was sort of trying to launch, but then they really struggle on bringing LPs and then sort of everything else. And then later on, when Rena, who is our current GP, when she joined, like it was like really clear. It was really amazing because she basically, we were all struggling on fundraising for the Turkey fund, and then she raised during the coup she did her first closing, and now she's running the fund, right? So it's really that like Turkey is a great market, but also we found Rena, who is an awesome GP, and then that's sort of like the two perfect combination for 500 to enter a new market.
With that said, we will sort of stop taking questions for Bedy. Again, there are a number of questions here. We've answered roughly 30 of them online, and there are another 20 open. Sorry, everyone, we won't be able to get to all the questions in these sessions, but we're glad that you have them. And we're so excited for you all to join us at our session that we'll be having in June. Again, those dates are June 18th through June 29th, and that'll be hosted with our partners in Silicon Valley at Stanford University. If you have any questions about the program, about what you've seen today, please feel free to go ahead and mail them to vcunlocked at 500startups.com. We monitor that mailbox. The education team monitors that mailbox, and we'll get back to you shortly. Again, the deadline for early applications is tomorrow, so we highly encourage you to submit your application for, again, this upcoming program. And please take some time to go to our site and look at the work, look at the diversity scholarship, and for those people who are helping to expand what a venture capitalist looks like around the world, please go and apply for that fellowship. We're really excited to have that opportunity to bring more people into the fold. With that said, thank you all for joining us for this webinar. We'll be hosting another webinar next month. I will give you the exact date right now. The next webinar is going to be on April 18th, and it'll be with our partner, Edith Yang, who is going to be talking about our new track on blockchain, our blockchain track, which will also include sort of our take on the future of finance and why it's important to really understand what's happening there. Edith will also be teaching at our program at Stanford this year, talking a little bit more about that as well. So if you're interested, we'll be sending out information along with some of the slides from this webinar, either tomorrow or Monday. And we hope that we will see you all again for that upcoming webinar, and then hopefully see you in person in Stanford in June. With that said, we'll close it out.
Thank you, everyone.